Let us now look at Article 3.5. We talked about the allocation of income to PEs. Now we're going to talk about the allocation of income or losses from a flow-through entity. And the very first question that we need to ask ourselves is, what is a flow-through entity? And obviously we need to go to Article 10 to find the definition of flow-through entities. And you see here we've got a whole list of flow-through entities, tax-transparent entities, that's the second block on the left-hand side, reverse hybrids and hybrid entities. And if we look at 10.2.1, the text, an entity is a flow-through entity to the extent it is fiscally transparent in the jurisdiction where it was created, unless it is a tax resident in another jurisdiction. So in short, an entity is a flow-through entity if it is fiscally transparent in its residence jurisdiction, because if it was incorporated in another jurisdiction and then moved to this jurisdiction to be resident here, it's always residence always trumps incorporation under this definition. But now we still don't know what the globe rules mean by a transparent entity. We now know that a flow-through entity is an entity that is transparent in its resident state. And then if we look at 10.2.2, an entity is treated as fiscally transparent under the laws of a jurisdiction, so the residence jurisdiction, if that jurisdiction treats the income, expenditure, profit or loss of that entity as if it were derived or incurred by the direct owner of that entity in proportion to its interest in that entity. Yeah, so the resident jurisdiction does not tax the entity, it taxes the owners of the entity. So if we look on the figure on the right hand side, we have an overarching category of entities which has a subcategory, the light blue block, of flow-through entities, and some of those flow-through entities are tax transparent entities. If we look at Mr. A and Mr. B holding 60 and 40% of the tax transparent entity, the TTE under Article 10.2.2, then clearly if the TTE earns 100, 60 of that will be taxed in the hands of Mr. A and 40 of that will be taxed in the hands of Mr. B, if this is a fiscally transparent entity or tax transparent entity, as we talk about under Article 10.2.2. And then you see the funny little dark blue house in the bottom left of the graphic. And what is that supposed to mean? It says it's a partially flow-through entity. And if you look at the wording of 10.2.1, it says an entity is a flow-through entity to the extent that it is fiscally transparent. So what that means is, if for whatever reason, for instance, a country says we will treat an entity as if it is transparent for instance, its active income, but we will tax it for its passive income, then to the extent that it is transparent for the active entity, it will be a flow-through entity, and then it will be a tax transparent entity. But for passive income, it will be treated as a normal taxable entity, and the entity will be taxed itself, not the owners thereof. I hope this explanation makes the difference clear. The next category of entities that we need to look at are hybrid entities. And if we start at the bottom left of the slide and we look at 10.2.5, then we see that 10.2.5 says an entity that is treated as a separate taxable person in the jurisdiction where it is located is a hybrid entity to the extent that it is fiscally transparent in the jurisdiction where the owner is located. So if we look at the middle block of the graphic, you now see we've got two countries. We've got the owner state at the top, we've got the flow-through entity state at the bottom. And we see that at the bottom the hybrid is a square, because transparency normally means you look at a triangle, right? And when you look at the sharp end of the triangle, wherever that points, that is the country that sees the entity as a flow-through or as transparent. In this particular case, the triangle points to the top, to the owner state. So the bottom, the flow-through entity state, sees this entity as a normal taxable company. And if that entity, the bottom entity, were to earn 100 in income, the flow-through state will tax the hybrid for the full 100 income. However, the owners in the owner state are treated differently. The owner state says, I look right through this thing because the sharp point of the triangle points toward me. I see a transparent entity. I'm going to tax the owners as if the income, this 100, were earned by the owners. Now, how do we stop double tax from happening here? If you think about a real life situation, it's most likely that the hybrid is a company in the state where it is. It has an office, which means it has a permanent establishment, which means it will be taxed in the flow-through entity state, even by the owner. In the owner state, they will say, clearly you have a PE in the FTE state, so we will either give you a credit for whatever tax you pay there, or we will exempt you, but we will not tax you. So if you look at the top text under hybrids 10.2.5, you see the owner state taxes the owners. The hybrid is probably a PE in the flow-through entity state from the owner state perspective, which means that the income will be allocated to the flow-through entity state and the owner state will provide some form of double tax relief. And then finally we come to reverse hybrids, and if we look at Article 10.2.1b, on the left-hand side of the slide, you see a flow-through entity is a reverse hybrid entity to the extent that it is not fiscally transparent in the jurisdiction in which the owner is located. Now, we already talked about that a flow-through entity and transparent entity is transparent in the jurisdiction where it is resident. But now it says a flow-through entity is a reverse entity to the extent that it is not fiscally transparent in the jurisdiction where the owner is located. So if we look at the far right of the graphic, you can see the arrow in the bottom entity is now pointing downwards, which means that the flow-through entity sees the reverse hybrid as a nothing, a flow-through entity. So it will not tax the income of that flow-through entity. The 100 will simply be allocated to the owners, and unless the owners are deemed to have a PE in the flow-through entity state, they will not pay tax in the flow-through entity state. And then what happens in the owner state? Well, in the owner state, the owners look down and see the blunt end of the triangle. So for them, this is an entity, this is not a nothing. And they will say, well, we can't tax the reverse hybrid in the owner state because the owners in the owner state clearly own something that must be a company or a taxable entity in the flow-through entity state, and therefore we can't tax it. So the consequence of a reverse hybrid very often is no tax, because the flow-through entity state says I don't see anything and I don't tax what I can't see, and the owner entity says there's a subsidiary on the other side, I can't tax it because Article 7 of the Model Tax Convention prevents me from doing so. So you'll also find that when it comes to the GLOBE rules, they will say, we are simply going to allocate all this 100 to the flow-through entity state, and if you don't pay any tax on the flow-through entity state, that simply means that your top-up tax in the flow-through entity state will be 15%. So now that we know what the differences are between flow-through entities, tax-transparent entities, reverse hybrids, and hybrid entities, let's look at what 10.3.5 actually says.